Let's bring in John Kolovos, head of technical strategy at Macro Risk Advisors. John, it's good to have you here. Certainly in following your work, I know you were giving credit to the market for this recent reversal higher just because it was broad and you had a little bit of a sense of urgency in some of the technical readings off of that low, but maybe not getting escape velocity just yet. What still gives you pause?
Yeah, so thanks, Mike. Thanks for having me on. Happy Thanksgiving. So what's giving me pause? Well, where do I begin? I would say, for starters, it's still the lack of breadth that's going on. The Magnificent Seven is quite magnificent. There's really nothing wrong with those particular stocks. It's just the market of stocks themselves are troublesome. So what I've been telling clients is this: it's okay to be bullish the S&P, but it's not okay to be bullish the market of stocks. So number one, it's breadth. Number two, yeah, the macro has gotten a little bit better over the last couple of weeks, but it's really hard to say with high degree of confidence that the trend of interest rates has fully reversed or that the dollar is going to be breaking significantly lower right away.
You know, the breadth divergences, or the fact that the average stock has vastly lagged the S&P 500 market cap weighted, it's clear to everyone. It's been kind of remarked upon. People are unnerved by it to some degree. I do think it makes sense, though, to get at exactly why you feel that it is an issue. I mean, about a third of the S&P 500 stocks are up 10% plus this year. That's not a lot, but that's not seven. And I just wonder what it is about relatively weak breadth that should be worrisome.
Sure. Okay. I think it really goes into animal spirits, right? So when I talk to clients, unfortunately, they have to own more than 7 stocks, right? So when I sit down with them, I go through their portfolios. A lot of their stocks, a good chunk of their portfolios look like the Russell 2000 or the RSP. It doesn't really give them a lot of conviction to go further out on the risk curve. So you need to see those parts of the market perk up, break out, and turn into uptrends for animal spirits to kick in. And that way we can have a strong bull market of everything. Right now it's just a bull market of just a few. Now, can the S&P continue to push up higher? Like I said earlier, sure. The Magnificent Seven's fine. They're up a lot, sure, but there's no real chart damage there. So the S&P 500, if it were to break out above the highs of 22, we could be looking as high as 52.25, if not 5,500 at some point next year. So I think more of the same is basically what I think is going to happen for next year.
Interesting. And so as we monitor how things are handled, I mean, the market in the short term looks, kind of stretched already. You're probably going to get some kind of a pullback. How would you be grading things on that pullback?
Right. Great question. And I think that's really what we need to observe here on the market is how the next pullback comes. We already know there's demand at lower prices. We saw those in those breadth rusts, but this has been uncorrected. So what are we looking for? One, we just want to have a corrective decline, something that doesn't have negative breadth, low volumes on the downside. Don't really want to see the S&P break down underneath 4,200 in any sort of meaningful way. If that breaks 4,100 in particular, then guess what? This 2-year range or bear market, because it kind of still is until you make a higher high, it still is a bear market, can work lower, maybe as low as 3,800, if not more.